I have seen thousands of traders' price charts and identified exactly where all of them are consistently losing money. Every single trader always makes the same repeatable mistakes. Trading isn't about eliminating losses because we're all going to take losses in trading. It's about losing in locations that we could have won. So in today's video, I'm going to highlight the key areas on the chart where you're probably taking most of your unnecessary losses. Then you can cross-reference what you learned today with your own trades and improve your trading locations and trade direction.
So let's first start here by understanding this price delivery. Now, this is a normal price delivery within the market. A lot of traders, when they show you price deliveries, will always show you the perfect legs up and legs down. They'll show you a consolidation that looks perfect, and then they'll show you a nice bullish trending market. Realistically, the market doesn't look like this all the time. So we need to understand the advanced way to look at price action. Now, this is the advanced way to look at price action. If we break down the market structure first, the reason we want to break down the market structure first is because when we understand the market structure, then we can start to understand where we're positioning ourselves on the charts and why we're taking losses in those locations so that we can improve our trading locations and we can improve our probability of catching winning trades. So let's start here on the left, right? Everyone knows what market structure this is. This is a bullish trending market structure. We're getting higher lows and higher highs. We know that when we're in a bullish trend, we want to be looking for buying continuations. Now, let's just understand why you may be taking losses in a bullish trend, because this is the easiest market to trade. Now, all of these reactions that we see here from these swing points here, these are all reactions from a sideways range. If we look to the left here on the charts in this leg up, we will always find a sideways market where price is reacting from on the right hand side of the charts. And again, exactly the same down here. In this move up, what we're going to see is a move up, a sideways range. We're going to move up, a sideways range, and we're going to move up, and then we're going to start to get that pullback. This is realistically how price creates this A to B leg that we have here. The reason we can understand that price is going to create sideways ranges and see continuations is because we know how to read initiation structure within the market. And these big moves, or these big A to B legs that we see within the market, these are initiation market structures, which means that we're going to be leaving behind sideways ranges as we're creating moves up into higher prices. These sideways ranges that are going to be created in this initiation structure are going to be used in the future as potential reaction points for potential big continuations to create that next big leg within the market. So once we can identify these sideways ranges, which we will teach you how to read these in our Trading Missing Pieces price action course, we know the potential locations on the chart that price may want to react from to see that next massive move within the market, which is going to be that next big initiation within the market, which we all want to be involved in. Now, that's our level of understanding so that we can understand where price may react and how we can position ourselves with our strategies to get involved in those big moves within the market. Now, let's take it back a second. Let's think about how we might be losing within these markets. And if this is you, this is fine. Losing is all a part of the experience of trading. We want to learn from our losses and understand why we lost so we can improve our trading and we can become a better price action trader. So if we identify that we're in a trending market, and if you're taking a lot of your buying opportunities very high up in this leg, maybe here you might start to think, I want to get involved in the market. The market's not going to stop. It's not going to pull back. It's going to keep going. I want to just try and scrape as much as I can out of this move. You might want to pass your funded account really quickly and see that there's an aggressive move up. Any of these reasons that are going to be giving you consistent losses within the markets, just because you're identifying a trending market, but you're buying too high within the trend. You've identified the correct market structure, but when we're in these market structures, you need to be patient enough to wait for price to pull back so that you can buy low and play continuations here to the upside. So this is the first layer to understanding why you might be losing within market structure. You're buying too high within the market structure. Also, a lot of traders here will see a sideways range, an initiation, a mitigation, and try and play a continuation and get taken out here. It's because you're buying too high within this trending market structure. So that's the first layer of understanding within a trending market structure as to why you may be losing trades. Now, let's move on to our next market structure. This is a sideways ranging market structure, also known as a consolidation market. Inside NJT, this is one of our favorite market structures to trade because they become so repeatable and consistent that we can position ourselves so easily before the biggest move happens within the market. Now, at NJT, we understand the best locations within a sideways range, and we understand the lowest probability locations inside a sideways range as well. So if you keep taking a lot of losses in a sideways ranging market, trying to trade it like a trending market, maybe inside this move you're seeing this as your A to B and you're trying to play that 50%, you keep getting reactions and then you keep getting taken out of trades. It's because this is not a trending market anymore. You cannot trade this in the same way as a trending market. You have to trade a sideways ranging market different to a trending market structure. But once you understand how to trade a sideways ranging market, it becomes a lot easier. So at NJT, we always focus on the best locations inside a sideways ranging market once we've identified that we're in a sideways ranging market. If you cannot identify a sideways ranging market yet, do not worry, we've broken down every single step of a sideways ranging market, all of the rules behind it, how to identify it in our Trade and Missing Pieces price action course. But then we understand where we're taking all of our losses. So if you're finding that all of your trades that you're taking are inside the middle of a sideways ranging market, you've just identified one of the most important parts of your trading that's going to help you to overcome those lost streaks. And with a simple switch of just focusing on the edges of a sideways range, you're going to start to maximize your profit potential and give yourself the best opportunity to make profit within the market. So once we've identified the market structure here, we understand where we want to position ourselves within the market structure, where we want to stay away from within the market structure. Then it's all about our entries and our strategies to get involved at these locations. Now that's the second layer to understanding why you might be losing in the market. And don't worry, we'll go on the charts in a second and we'll go through actual chart examples. Now, after price breaks out of a sideways range, we always have the initiation phase. This is exactly the same as what's happening here from these points of mitigation. These are all from a previous sideways range. If we look to the left, here again, swing points always come from previous sideways ranges. The reason they always come from previous sideways ranges is because this is the pattern that the banks use in order to transact the biggest orders within the markets. So once we understand the RAMC pattern, we understand where the biggest moves happen from in the markets, and this is how structure is being created within the market, and this is how we get those higher highs and higher lows within the market. So if we come back to our diagram here, we can see that price has had a sideways range and we've broken out of that sideways range. We've then created an initiation market structure. Now, what a lot of traders do in this initiation market structure is they look to the left here at previous structure points or previous order blocks here to the left. And what they're trying to do is they're trying to buy this back up. They're trying to buy the pullback, or they're trying to buy the next big move within the market. But they're failing to understand that because price has broken out of a sideways range and we're in a bearish initiation, you only ever want to trade with that initiation market structure because these are the most volatile market conditions. We want to trade with the volatility so that we can stay on the correct side of the market. So if you're identifying that price has broken out of a sideways range and we're now in a volatile market and you keep looking to buy against the initiation, again, you've just identified another way where you can have a simple switch within your trading and you can transform your results. So these are the three keys right here to understanding why you're losing with market structure. So have a look back at your trades, understand the market structure that we were in, and then next time with a simple shift, you can be on the correct side of the market and you can position yourselves on the correct side. So now let's go into some examples on the charts and we can look at how we can change our results and transform the way that we look at the market just by understanding these advanced price action concepts. Okay, so onto the charts now. The reason that I've picked this price action here is because it incorporates all of the market structures that we just went through, and it shows that the market doesn't just move in that perfect trending market all the time. we actually create those 3 different market structures that we just went through. So what we're going to do now is just understand the market structures first, which is the first initial layer that we should always understand when coming to the charts. And once we've identified these market structures, now we can start to see why we may have been taking our losing trades and how we can start to position ourselves in the future into those winning positions. So if we just start up here to the left, right? As I said, when the market is in a trending market, we're going to be creating those lower highs and lower lows within the market. This is the best and easiest market structure to trade. However, if you're finding that you're seeing the market in this trending market and you're seeing these continuations to the downside and you're trying to get involved at selling the market too low within this move and you're seeing your reactions and then you keep getting taken out of your trades, one simple fix that you can add to your trading is add in the A to B location tool and only selling high, which is above that 50% area, or only buying low if we're in a bullish trend, and always putting your stop loss above the previous swing high. Now, like I said before as well, the swing points are created from previous sideways ranges. So if we look to the left, this is a very large sideways range, followed by an initiation, mitigation, continuation. And that creates those swing points within the market. So once we can identify that we're in a bearish trend, which we would have identified way back here, when we broke structure here to the downside, and we created those lower highs and lower lows, we now know that we're automatically going to be looking above the 50% area. Then what's above the 50%? Well, we have a sell order here that we can play as a reaction for the next big move that happens within the market. So that means that we can stay out of these low probability trades that are causing us consistent losses within the markets, and we can position ourselves in the highest probability trades with the safest stop loss so we can maximize our profit potential in a trending market. Now, what market structure do we see? We see price moving very, very aggressively here to the downside. Now, if you've missed the move here, then the move is gone. Don't worry about trying to buy this back up or buy every single reaction on the way back up, especially when you see a candle like this, which would have come all the way up to the high here. If you bought this with your stop underneath here or your stop not in a safe location because you're looking to the left on the charts and you're seeing, well, there's a sideways range here that I can play, you're missing the most important part. And the most important part is the market structure, which is in a bearish initiation market structure. Remember I said the biggest moves of the market are always going to come from a sideways range or from a point of mitigation and seeing a continuation phase in the market. You do not want to trade against these market structures because you're going to take unnecessary consistent losses. So if you are finding that a lot of your losses are coming from trading against this bearish initiation structure or trading against the continuation from the RIMC, it's a very simple fix. Understand the market structure first. We are in an initiation structure. Now I'm only positioning myself with the volatility that's in the market, which means you're only going to look for those selling continuations. Now, this is a 15-minute chart. If you're trading on the minute chart and you have a 1-minute strategy or a 5-minute strategy, you can look to trade bearish continuations, trading with this volatility that you see in the markets. It's a small shift within how you look at price, but it's going to have a massive impact on your results. Now, we see market structure start to slow down here, and then we start to see a bullish market structure. We create a low, a higher low, and then we break structure here to the upside, and we create that bullish trend within the market. Now, after we had that bullish break of structure here, now what are we looking? We're looking for bullish continuations. When price starts to stop here, we're waiting for price to pull back into the 50% area or into the discounted price so we can look to trade our buy continuations. As we can see here, price doesn't pull back into that 50% area for those buy continuations, which means we do not trade. That's as easy as I can make it for you. If the market doesn't set up with your rules perfectly, you do not have to trade the market. You only make money when your setup presents itself. If your setup does not present itself, you do not get involved in the market. You need to discipline yourself to stay out of the market when you don't get your setups if you really want to become a consistently profitable trader. So as we can see, if we're not in a trending market structure, we are in a bullish initiation market structure. So we're seeing moves up, we're seeing sideways ranges, moves up, sideways ranges, and then we're seeing moves up. We pull back into where? We pull back into a previous sideways range. What did I say? Sideways range, initiation, mitigation. These mitigation create the next swing point within the market, and then we start to see continuation market structure here. Now, when price comes back up into this mitigation here, we can start to identify that price is moving in a sideways ranging structure. Between this high to this low that we have down here, price has now created a sideways ranging market, which means price is slowing down, which means price is starting to change its direction within the market. So now we know the best opportunities within that sideways ranging market are always going to come from the same specific locations, and we want to stay away from the middle of the sideways range. We have our narrative for lower prices because we're playing sideways range, initiation, mitigation, continuation. So now we want to be positioning ourselves in a very specific location on the chart where we can maximize our profit potential for that next big move when we break out of the sideways range. So if a lot of your trades here, when you start to see this bullish momentum, you start trying to trade every single 50% continuation, you keep getting taken out of the trade, then you say, okay, the market structure's changed. Now I want to be looking for my sell continuations here, right in the middle of the range, and you keep getting taken out of your trades again. This is because you need to identify the market structure first. Now we can start to position ourselves in the best locations with the safest stop losses and play the direction of the market. So this is exactly how I trade. I trade the direction with my strategy. I position myself inside the sideways range with the safest stop loss, and I play the direction of the market, anticipating that next big move within the market with a positive risk to reward. So this is the second phase of understanding where you're taking your losses from. But the most important part is identifying the sideways range and identifying the initiation market and identifying the trending market structure. Because once you can identify these market structures, automatically your mind can go into a process-orientated mindset and you can position yourselves in the best locations on the charts to maximize that profit potential. Then what happens? We break out of the sideways range here. What did I say after price breaks out of a sideways range? We always move into initiation market structure. So again, a lot of what traders will do is they'll see all of these locations on the charts where we have sideways range or we have order blocks, and they'll be looking to trade these as their reactions. So they'll be putting their entries here, they'll be putting their stop underneath the order block, and they'll be looking to trade this as their long. Not understanding that the market has changed its structure because we're from a previous mitigation here, and now we're trading with that bearish order flow that's in the market. So instead of looking at the left side of the charts here and looking at all of these areas where you can potentially look for your trades, always trade with the intention that's in the market from previous sideways ranges, and you can start to position yourselves on the right side of the market. And this is how we're utilizing market structure with our pattern of RAMC to make sure that we're trading on the correct side of the market. It's really important to understand the market structure first and not look at it as this trending market structure up and down and these nice easy consolidations, but actually start to understand the flow of how price moves in these different market structures. Then we can use our strategies with our safe stop losses to play that direction of the market and maximize our profit potential. If you enjoyed this video and you learned something about why you're losing trades in these market structures, make sure you leave us a comment down below. If you enjoyed the video, like the video as well. If you want to find out more about how we trade these markets with our advanced price action concepts, you can look at our website at notjustatrade.com. Thank you very much for watching, and we'll catch you on the next video.